So we're talking to you today about long-term care insurance. And I've been offering long-term care insurance since the 1970s. It's that as long as the product's been around. And this product has almost zero demand. And so why would you want to get in the business of selling something that there's zero demand for? And that's really been consistent through almost 50 years of selling it, is that people are not just walking through our door saying, why don't you get me one of those long-term care policies? And if they are, it's generally they're somebody that's just had an event themselves or with their family. They've just had a long-term care event. They had experience with it and they can realize the need for it. So there's almost zero demand for this product. So what we're going to be doing today is we're going to be talking about long-term care insurance with the inflation rider. And we're going to talk about the cost of it or the premiums that you're going to pay to get yourself a policy. So with that, I want to bring Tom on, and I want Tom to talk about why are we doing this video today?
Yeah, I mean, we're doing this video because if a long-term care event happens to you, it has consequences on your family, right? This will be the single most impactful thing that they've ever had to deal with in relation to you and the family and the money. And so the real reason you do this planning is for your family. It's less about you. It's protecting them from what they have to go through. And so I want to bring up the show notes here. You can find these at the link below our video. They're also on our website at cardinalguide.com. I'm just going to scroll through pretty quickly here. These are the examples we have on the board. So if you're watching this video and you actually want to go look at all the numbers that are supported on the board, you can get here. We'll point out sort of which one is which as we go through the board. They're quite lengthy, so you sort of need to know which one you're looking for. But again, if you want to see actual numbers of the examples we're using, you can find those in the show notes.
Yeah, I think part of the reason there's zero demand for this product is people don't really believe that this is going to happen to them, or they just think somehow they're going to miss out on this. They're going to luck out. They come up with all kinds of reasons. And so, what I'd like to do through this video and other videos that we produce about long term care is increase the demand a bit and get people to face the facts and to begin to plan for this. So, today's video, we're going to be comparing two different ways you can solve for this problem. One is a traditional long term care policy, just what you've read about. Most people, when I ask them what is long term care insurance, they're going to come up with an answer, which is a traditional long term care policy. That's the policy that's been around for 50 years or almost 50 years that I've been offering. And we're going to be comparing that to a hybrid life long term care policy. So the alternative has been around for about 15 years, 20 years. Um, really, the Pension Protection Act created it under the tax law, under the IRS, made it feasible to do this tax-wise. And what this is a life insurance policy that has a long-term care policy buried or baked right inside of it. So what it is a policy that you pay a premium, you pay an amount of money, a significant amount of money if you pay it in a lump sum in a single premium to the insurance company, and then either you or your heirs are going to get something out of this. If you're going to get something out of it, if you have a need for long-term care, you're going to get way more than you put in. And if you go through your life and you don't need any long-term care, you just need a little bit, what it's going to do is when you pass away, it's going to pay back your premium and then some to your heirs, okay? Or it's going to basically return that premium to your heirs because you didn't use it. So that's the difference. One is pure insurance, traditional long-term care insurance. The other one is hybrid life long-term care insurance. And what we're doing is we're looking at a 65-year-old male and a 65-year-old female. And in the case of the couple, these two people are married or they're partners, and they are buying a joint policy. And there's some discounts or there's some economies of scale for going on the same policy. And we're going to be looking at the pricing. But before we get into the pricing, I want to show you the benefits, and especially with the inflation rider. So if we're starting out, both policies, both the traditional and the hybrid policy, start out at $6,000 a month. That means if the people bought it at 65 and they immediately started using it, they would get paid $6,000 a month for either home health care, assisted living, or nursing home care. Or there's a few other things listed on there, but most of these people in the modern day at least try to start out using home health care. I want to stay home before I go in. And so I'm just trying to give you some context to these numbers. It's 6,000 a month is where you're going to start at. But this policy, both of these policies have a 3% compound inflation rider built into them. So let's start looking at this when you're probably going to be using this. And if we look at it like age 85, that 6,000 has become 10,837 a month. And that is 130,000 a year. That's $520,000 maximum benefit. And in the case of the couple, it's over $1 million. And so, and if people purchase this as a couple, pretty good chance that the first one, I'm going to start using it somewhere in their 80s, maybe their low 80s or their mid 80s. And then the other one is going to survive and live on. And then that person is going to use it at an even older ages. And I've illustrated, this keeps right on growing, but I've illustrated somebody using it at 95. It's 14,000 a month, 175 grand a year, or almost $1.4 million for the couple of total benefit that can be paid out. And that's what you're insuring against, is these numbers right here. And too often people are just looking at this first number. So those are the benefits. And before I move on to the cost and the life insurance benefit, I want Tom to come on and I want him to react to these numbers a bit.
Yeah, I mean, I think it's important to look at the benefits, like what are you getting at some future date. But I think too often you can get caught up in just the numbers and trying to run the math. Like, okay, if I take this money and I invest it, what could I get? What kind of return would I need to get? And again, I think that's a reasonable place to get to, but I think you're missing the point, right? I mean, oftentimes the decisions around this is less about the money because we have tons of clients that objectively have plenty of money where they could pay for this care if it were to happen to them out of their wealth, out of their assets. But when we play that out, because we have a lot of clients that are sort of at that point where they're needing care and they are very unwilling to spend it, right? I mean, almost by definition, if you've been a good saver your whole life, it's hard to then turn around and spend that money on something that you really wish you didn't need to spend it on, right? There's a lot of denial that goes into this. It's hard to admit your fragility where you're not able to get around and do stuff. And just as things happen, it's hard to know when that is, and who ends up bearing the burden of that is your family. It's your spouse or it's your kids, right? Those are the ones who step in, and they might be the ones saying, "Oh, don't pay for that. We can do that." And that could be because they're trying to preserve what they're going to get, or your spouse is trying to make sure they have enough to take care of themselves. And so they end up putting their lives on hold to take care of you. And oftentimes that ends up leading them to get sick, right? I mean, when I got sick, and again, if you've watched the show, I had an autoimmune disease. I was young. I was in my 20s. I was in a wheelchair for a while. My wife's trying to take care of me, trying to take care of our 8-month-old child at the time. And she ended up getting sick, trying to take care of me. And then Hans, your mom went through that when she was trying to take care of your dad, right? I mean, it happens all the time where the caregiver who's taking care of a chronically ill person, they end up getting sick themselves. And so even though you need to look at the numbers, they're important, you need to know what the benefits you're getting, you really need to think through what kind of strain that's putting on your family and the decisions they're going to have to make, because in absence of planning, they're going to have to make this choice. They're going to have to make decisions because they won't have a choice. And so it's much better to have thought through this a little bit ahead of time, to set things up in a way that they know what to do. They're more willing to do it. You've had this policy in place, and now the time comes where you might need care, it's a much easier transition. And again, it's not to say that it's an easy thing you're going through, because it's still a crisis, right? You're still going through an issue that you're needing care for. That's never a good situation, but you want the focus to be on the care itself and less on the money aspect. And all too often, when we're meeting people, families that are in that moment, the planning wasn't done, they're in a crisis, they're trying to figure out what to do, the conversation is revolving all around the money. and less about the care that's being provided. So again, I just want you to really think through that, and take some time and seriously think through it, and not just sort of blow this off.
Well, and a lot of people, that this could be you are just saying, I'll just self-insure. I got enough money. I'm looking at this, and I'll just take care of this bill when it comes around. And I think a couple of points with that is, this isn't going to be you making the decisions at this point. You're the one needing care. Even though you're the money manager now, it's going to be your spouse, or most likely one of your adult kids, is going to have to make the decision to spend your money on your care. And they bring you into the decision. That's a difficult decision to make. And a lot of older spouses that were healthy at the beginning of the event get sick, just like Tom's wife did, taking care of him. So enough on that. These are the numbers. You buy this thing in a monthly amount, an annual amount, and what we're showing here is a 4-year maximum. We have policies with some different companies than these under the hybrid side that are unlimited, that have no 4-year maximum. So you can, this is not to be limited, this is just to do a comparison. So this is a 4-year maximum, and on the couples policy, it's an 8-year maximum, and either of you can use any part of that. So one of you could use 6 years and the other one uses 2 years, vice versa. One of you could use all 8 years and that would leave nothing for the other one. But the point being that the benefits are similar. Now, we want to talk about the life insurance benefit, and keep in mind that the life insurance benefit only pays out unless if you don't use it, or the full life insurance benefit only pays out if you don't use it up for long-term care. So on the traditional long-term care policy, there is no life insurance benefit. I mean, you're simply, your heirs are going to get nothing back out of that thing. And people bring that up as an objection to buying it. Well, I'm going to pay into that for all those years, and I'm going to have a heart attack, and I'm going to pass away and never go in a nursing home, or never go to assisted living, never use home health care. It's all, this was for nothing. Well, that's kind of the way insurance works. And so you pay premiums. You don't get a rebate on your fire insurance or your homeowner's insurance if you went 30 years without a major claim. But in any case, that's traditional. There is no life insurance benefit on traditional long-term care. On the hybrid long-term care life insurance, for the couple, there's a $216,000 death benefit. So if both of them don't use it, or they use it a little bit, then the little bit will be deducted from the $216,000 and be paid to their heirs. In any event, if both of them use it to the max, there's still a $21,000 death benefit. And on the single policies of the hybrid, the single, it's a $288,000 death benefit for when it's not used. It's a $28,000 benefit if they use up all the life insurance for long-term care. There's still a residual death benefit. So I want Tom to talk about that a little bit.
I mean, I think the death benefit is sort of a secondary thought on this policy, right? You're doing this planning really more around the long term care side of it. But it is a nice feature that if I don't use care, because again, we don't have that crystal ball. We don't know if you specifically will need it. We can look at statistics and see on average how many people use it, but that's not that helpful, because it's either going to be 100% you use it or 100% you don't. And again, we don't know which side you're going to be on. And so what the life insurance does is it really has something coming back to the family, right, to your beneficiaries at that point. And so again, it's not the primary reason we're recommending this when we're doing this type of policy. The long-term care is the main focus, but it is a nice feature there. And then on the traditional side, again, what's nice about that is the cost is less. We'll get to the premiums here in a second on the board. But it's less expensive because you're not having to pay for that life insurance component. And it is you pay for it. If you don't need it, then at least you had that coverage during that time, because again, you didn't know. And is in a way that's almost a better situation, right? If you don't need the long-term care policy, that means you never needed long-term care, which I think would be everyone's goal. But realistically, we know that's not to be the case. There is a certain percentage of people that are gonna need long-term care, and that's why you need to do the planning.
Now, for the single premium, what we're going to show you here is the single premium, the 10 pay, and the lifetime pay cost. So for the traditional long-term care, the lifetime pay amount is for the couple is 14,611 a year. So, in 20 years, you're going to pay in like 280 grand. People look at that and they say, oh, it's too much. And so that's kind of why I went over the benefits is if they had to pay out a claim on everybody, they'd have to charge way more than this. Okay. Now, the 14,611 a year is the couple's price, and it includes the shared care benefit, meaning that if one person goes over their 4 years of care, they can dip into the other spouse's 4 years, so they can use the 8 years combined jointly and together. If we break the policy into two policies, or we have a single person, single female looking at it, single male, age 65, the female is $94.91 a year, and the male is $5,328. Big difference, and there's just a greater chance of females using it and using it for the whole period of time that the policy's there. So the ladies' portion of that is significantly more than the man's.
I do want to make one more point too on the benefits, right? If you do qualify for benefits, those benefits come in tax free, right? So you're not having to pay tax on that difference of what you put into it versus what you're getting out from a benefit standpoint. And so when you're doing this sort of thinking through of it, comparing it to like investments, which again, it's not a fair comparison, but you need to factor in the tax portion too, right? Those benefits coming in tax free, so they're not having to worry about what that's doing to your taxable income.
Well, that's huge, especially when you're compromised in your ability to go through a daily routine, and you're compromised in your ability to handle the finances and do all that. This is turned over to your daughter or your son. Just to know they're going to have a tax problem if you're paying for this care out of your assets. And with this, you're not. Good point, Tom. Now, to be fair, when we're comparing these premiums, this traditional long-term care, which you're paying for life, has a waiver of premium on it. And if it's a couple's policy, it'll waive the premium for both spouses, even if only one is using it. So when you begin to use the care, the premiums are stopped or they're waived for the whole period of time that you're using the care. Now, if that spouse passes away, then the surviving spouse is that the premium's going to come back in the picture, just their portion of it, for the rest of their life until it's waived again. But there is a waiver of premium on this. And also, the traditional long-term care can raise the premium. Now, it's much more difficult to do than it was in the past. We could do another video on that, but that ability is there from the insurance company, and they have to get it approved by the state insurance department. But you're going to see down here with the hybrid life long-term care, there will be no rate increases. The rates can't change. So now to go into the hybrid life long-term care, for the couple to buy all of these benefits, if they pay by single premium, it's $220,000 one time, single premium, paid up for life. Okay. And we have a lot of people do this. And we have another company besides the one we're illustrating that can actually do this with IRA money. So we can take IRA money, set it aside, and have it spit out the premiums so that you don't have to come up with that much after-tax money all at the same time. So just put that, but for comparison purposes, we're using this one, $220,000. The 10 pay is $26,000 a year for 10 years. So we can calculate the interest savings of a single premium versus spreading it out over 10 years. If you come in and see us, we'll do that on your illustration and show you what kind of interest the insurance company is charging you or you're getting on your 220,000 but this is a way to spread it out. We also could offer you this policy and set up a lump out of your IRA to kick out 26 grand a year. So we have a lot of financial planning moves that we can make if you're interested in setting up one of these policies that fits in with your retirement plan. Now, for a single female, the cost of this policy and getting these benefits is $137,000 single premium and $17,526 of 10-year payments. And for the single male, $122,000 single premium, $15,000 for 10 years. Now, the illustrations for all 6 of these products that are in the show notes. So if you really want to, you go in there and you click on that link for the show notes, takes you to our website, and you can look at what's behind the video. You'll have an illustration for a 65-year-old person. Now, if you're younger than 65, if you're in your 50s, this is going to be substantially less. If you're over 65, it's going to be more. If one of you is over 65, we're just showing the price for 65-year-old people and at this benefit level. So, Tom, talk about those premiums for just a second.
Yeah, I think one of the differences of the two, right? Obviously, with the life insurance one, and if you're looking in the show notes, those are the nationwide policies. Just if you want to sort of look to see what you're looking for. One, they're guaranteed to remain the same, right? They can't change. Contractually, those are set. You know what you have from day one. On the traditional side, they are able to increase now. In the past, there have been a lot of rate increases. I think looking to the future, there's less of a chance of big rate increases like they've had historically, but the company could still raise the rates, right? They do have that ability. Now, they can't single you out. They have to raise it on the whole class of people, but that is something to consider. And again, you start looking at the numbers. The life insurance ones, it's either single pay or 10 pay, so that you would expect that to be a higher number than on a life pay for the other one. So there's some differences there, but this just gives you an idea of sort of what the cost would be. One of the things I like to point out, because people look at these numbers and say, hey, that seems pretty expensive. And it's a higher premium than maybe other insurance policies you're used to, but price is only a problem in the absence of value, right? What you're getting for the policy, what it's protecting against, and what it's providing in benefits is huge. And so, yes, that's why the premiums are higher. But you're getting a nice value from it, right? You're still getting a really good benefit there. And so you just need to think through that of like not just the pure number costs, but what you're getting for that. And I think it's helpful to put it in that context. And the other point I like to make out is, this is showing a pretty robust policy. $6,000 a month in today's dollars is a pretty decent policy. You don't have to insure the full risk, right? Let's say, you have other sources of income. You'll have Social Security. Maybe you have a pension. You have investments. Having some amount of money coming in, even if it doesn't cover the full risk, is still tremendously helpful, even if you have to supplement that with other sources. And so this doesn't need to be an all or nothing decision, right? It could be like, hey, I want some coverage, but I'm okay with insuring some of the risk myself or taking on some of that risk, but then pushing off some of the other risks to the insurance company. So again, that's why we like to do this in the context of a larger comprehensive financial plan, because when we're doing the plan, we can sort of look to see what is affordable to you, what makes sense as part of a plan, what is the risk of the care, and we can sort of structure it in that context to make sure that what we're recommending fits the sort of your situation the best. But again, even if you just were interested in a single policy, you didn't want to do the full plan, call us up. We can run through some numbers and see what makes the most sense for you.
Now, what we want to think about is if this happens to you, if you have a stroke and you're compromised and you go to an assisted living or a skilled nursing home next door to the hospital for 2 weeks or 3 weeks, and then you go home, but you can't go home by yourself and you need care. If this happens to you, and then the care is going to be stretched out over a long period of time, you're going to need to reallocate all your financial planning. It's going to have an effect on every financial decision that you've made to this point. And so we provide financial planning, comprehensive financial planning. Most of our clients come to us right at retirement or a few years before. Some of them come a few years after. And we take them through all these 7 topics, 7 worries. And so what we're talking about today is long-term care. Okay, that's the topic, obviously, of the show. But the first thing that's going to get reallocated to pay for that care is your Social Security check. And then Medicare is going to pay for that skilled nursing happening right after the hospital. It's not going to pay much after that. And your Medicare planning is affected. If you have to pull money out of your IRA 401k to pay for care, that's going to cause a big tax event. Big problems making big withdrawals from that to pay for care. It's going to, if we have a plan in place for your IRA and your distribution of that money, it's all going to be put in jeopardy with a long-term care event. Your income is just a reallocation of income. And we do this all the time where we say, how are we going to pay for it? And we sit there with people, maybe we didn't see them when they were 65 and they're now 85 and their kids are coming into us saying, how are we going to deal with it? How are we going to use mom's money to pay the bills? And we're going to do a reallocation of cash flow. And we're going to have to create cash flow. So this income thing is stressed. And then we got to, when the people are married, we got to take care of the surviving one as well. And even beyond the life of the person that's needing the care. Estate planning, this is going to affect your estate. With a lot of people, it runs through a lot of the estate as the cost of it. And then there's a tax effect to everything that we're talking about here. So what I want to tell you is I want to bring Tom back on. And I want to tell you that our practice, we provide advice on this. And if you want to come to us and you don't want all the financial planning, you just want to talk to us about a long-term care solution, we're all about that. We'll be glad to help you with that. Most of the time, we're going to need to look at all your finances to figure out how we're going to pay for it. And then we're also going to make sure that you need it. Because, some people, if they have very limited finances, they obviously can't afford a policy like this. And they're going to be dependent upon the government to end up paying for the back end of their care. But in any case, we're financial planners, and our practice really has a big specialty in long-term care. So with that, I want to tell you that I'm Hans Scheil.
And I'm Tom Griffith.
And we thank you very much for listening.
Thank you.